So let's proceed. So I want us to look at some question on valuation of business security. So open with me November 2019. November 2019, question 3C. November 2019, question 3C. And that's on valuation of business securities. So hoping you are there, and we are told that Fair Deal Industries Limited has recently been listed on Security Exchange. The company has a policy of paying out gradually increasing dividend per share over the past 5 years, as indicated below. So given the year, the earnings per share, the dividends per share. So now I want to give information about that, about the historical payment of dividend. So you can use that information to compute the growth rate. And we say that using the compounding method, how do we get the growth rate? Growth rate is dn do n root minus 1. Or you say that the dividend for the first period, that's our 2014, now label it as DO, then for 2015 D1, 2016 D2, D3, D4. Now D4, the one for 2018, becomes our DN, the most recent dividend. So in this case it would be 7.3. DO, we said is for the first period. In 2014, the dividend per share was 5. Period N, those are 4 years. Remember, I don't count DO. So it will be D1, D2, D3, D4. So D4, and then you minus 1. So how do we get that? We say that how do we get the fourth root? You'll take 7.3 divided by 5 equals. Then to get the fourth root, you press 4. Shift, raised to power, then you press answer equals, then you minus 1, and you get the growth rate as 0.1 or 10%. Additional information. The company has recently paid a dividend for the year ended that 1st December 2018. The shares are therefore quoted ex-dividend. The management is considering a change in the financing policy whereby greater financing will be provided from internally generated funds, that's the retained earnings. This is expected to reduce the dividend per share to 5 shillings in the year ending that 1st December 2019. The growth rate in earnings per share and dividend per share is expected to increase to 14% per annum from the year ending that 1st of December 2019. The company shareholders require minimum return on investment of 16%, so that's the same as cost of capital. Required. Using the dividend growth model, determine the market price per share as at that 1st December 2018 prior to the change in financing policy, prior to the change. So how determine the market price per share or PO? It's DO 1 plus G R minus G. DO is the most recent dividend, and you see that in this case our DO, it will not be 5, it will be 7.3. The one for 2018, it's 7.3. 1 plus the growth rate, and we expect to grow at the rate of 10%. We have already computed the growth rate, so 0.1. R is the required rate of return on the cost of capital. Note number 4, the company shareholders requires a minimum return on investment of 16%. So it's 0.16 minus G, the growth rate, it's 0.1. So what do you get? So with that, you get an amount of shillings 133.8. So that's the current market price per share before the proposal of that investment. Number two, the market price per share as of that 1st December 2018 under the new financing policy. So under the new financing policy, nothing will change. That to get the market price per share, it is DO 1 plus G R minus G. DO1 plus G, we said is the same as D1, the expected dividend, R minus G. So now, under the proposed financing policy, let's go to note number 2. Number 2, I told that the management is considering a change in the financing policy whereby greater financing will be provided from internally generated fund. This is expected to reduce the dividend per share to 5 shillings in the year ending that 1st December 2019. That's the coming financial year. We expect to pay a dividend of 5. The expected dividend you already given is 5. R does not change. The cost of capital is 16% minus the growth rate. Let's go to note number 3. The growth rate in earnings per share and dividend per share is expected to increase to 14. The growth rate is expected. Under new financing policy, we expect the growth rate to be 14, so 0.14. 5 divided by 0.02, that's approximately 250,000. So that means under new financing policy, the market price will hike up to 250 shillings. Number 3. The break-even growth rate in dividend per share. Break-even growth rate. Can you underline growth rate? Underline growth rate. So that's what we are computing. So what we are computing here is G. The break-even growth rate in dividend per share using the market price calculated in C1 above. Number, the break-even point. We know very well that at break-even point, the market price per share before the change will be the same as the market price per share after the change. We are told that the break-even growth rate in dividend per share using the market price calculated in C1 above. In C1 above, the market price per share we had is 133.8. That's the market price before the change. At break-even, it should be equal to market price after the change. And how do we get the market price after the change? Now, after the change, what we are computing, remember, we have to compute the growth rate. So this is how we get. It's D1, of which the dividend is not changing. R, the cost of capital will not change. It's 0.16 minus the growth rate. Now, this is what we need. Now, the question is, at break-even, we're saying that the market price before should be equal to the market price after the change. Before the change, the current market price per share is 103.8. Should be equal. Now, the question is that how much will be this growth rate, in that if you substitute this, also the market price after the change will also add up to 133.8. So you cross multiply. If you cross multiply, it will be 133.8, 0.16 minus G is equals to 5. We open the bracket. 133.8, you multiply by 0.16, so what do we get? So it will be 133.8 multiplied by 0.16, you will get 21.408 minus G is equals to 5. You take this to the other side, this goes to the other side. So if this goes to the other side, becomes minus 5, you will get 16.408 is equals to G. So that means in this case, our growth rate should be an amount of 16. Is that the case? So let me repeat here again. Here it's 133.8. So here tumekosea kidogo. We're opening the bracket. That one is okay. So 133.8 times G, it will be 133.8 G is equals to 5. So this goes to the other side, this goes to the other side. So it will be minus 5. So this one, it will be 16.408 is equals to 133.8 G. Therefore, you divide both sides by 133.8. 133.8. So how much should be our G? So divide by 133.8 and you get 12.26% or 0.1226. So that's how you get the break-even growth rate. Good. September 2021. September 2021, question 1C. Yeah, question 1C. Once you are told that, Delta Limited issued a 16% corporate bond with a par value of 1,000. So how much is the interest? We say that the interest on the debt is always based on the par value. Issued a 16% shillings 1,000 par value. So that means the interest income or interest expense is an amount of 160. The bond will be either be redeemed at 20% premium after 5 years. After 5 years, or convertible into equity at the conversion rate of 100 shillings per every 2 shares. Each ordinary share is currently trading at the security exchange for 50 shillings. That's the current market price. It's expected that the shares price will increase at a constant rate of 5% each year. The minimum required rate of return by investor is 12%. That's the cost of capital required. The current value of redeemable bond. So how do we get the market value of the bond or the intrinsic value? Market value of the bond. We said that using the fundamental theory, the value of the bond, you'll take the present value of an annuity, of which we say that the annuity in this case will represent the interest, because the interest, regardless of what will mean to be the same. Then you add the present value of maturity value. So the present value of an annuity, in this case is our interest, of which we have the interest per annum. The interest per annum is 16% of the par value, which is 160. Then you will discount to get the present value. Present value interest factor of an annuity. How much is the cost of capital? The minimum required rate of return by investor is 12%. Then we expect to be redeemed after how many years? After 5 years. So therefore it will be 160 times. This one is an annuity because we expect to receive to pay at the end of each financial year. 12% for 5 years, now using the annuity table. 12% for 5 years. And it will get 3.6048. Yeah, 3.6048. And in that case, what do we get? So to get an amount of 576,768. So now you already have the present value of an annuity, and then we determine the present value of maturity value. Present value of maturity value. We say that maturity value of any debt, it will always mature at the par value, of which the par value is 1,000. Then we will discount. It will mature at the end of the 5th year. Present value interest factor, this one is not an annuity. 12% after 5 years, so therefore it will be 1,000. 12% for 5 years, this one is not an annuity since it will only happen once. So, but in this case, now let's change something here. The maturity value, you see that it mature at par value. But in this case, we are told that. Let's go to the second sentence. The bond will either be redeemed at 125% at 20% premium. So the maturity it will mature at 20% premium. So therefore the maturity will be 120% of the par value, which is 1,000. That means it will mature at 1.2. I mean 1,200. Then you discount present value interest factor, 12%, 5 years. So it will be 1,200. If you're not told that information about 20% premium, you could have just worked with the par value. But in this case, we're told that it will mature at a premium of 20%. So it's par value, and then you add a premium of 20%, which is 1,200. So here we have it 0.5674, and in that case, you'll get an amount of 680.88. Then you add the two. Present value of an annuity, we have it's 576. Present value of maturity value we have is 680, and with that you'll get an amount of 1257.65 shillings. And that's the current market value of a redeemable bond. Number two of the question was the current value of convertible bond. Value of convertible bond. the formula does not change. You still take the present value of an annuity, that one does not change. So the present value of annuity, the interest will not change. And the present value of an annuity we have it's 576.768. Now what will change is the maturity value. Now if you are to convert, what was the conversion terms? Now let's go back to that paragraph. The bond, now the second paragraph, the bond will, the second sentence of the first paragraph. The bond will either be redeemed at 20% premium after 5 years or convertible into equity at a conversion rate of shillings 100 per 2 ordinary shares. So that means for every shillings 100, you get 2 shares. How much was the par value? The par value was 1,000. So that means in 1,000, you have how many shares? So that's 2,000 divided by 100, it would be equivalent to 20 shares. Now if it is equivalent to 20 shares, how much is the market price per share? So to get market price per share, you take the current market price per share, 1 plus the growth rate. So now let's read that. Each ordinary share is currently trading, that's currently trading at the security exchange at 50. The current market price is 50, but you say it will be converted at the end of the 5th year. So how much will be the market price at the end of the 5th year? It's expected that the shares price will increase at a constant rate of 5% each year. So the growth rate is 5%, 0.05, and then you want the price after 5 years. So how much will be the market price after 5 years? So the market price after the 5th year will be an amount of 63.81 shillings. So therefore the maturity value will be 20 shares, it will be convertible into 20 shares each. The market price will be 63.81. So that you get the maturity value. Once you get the maturity value discount, present value interest factor, 12% after 5 years. So it will be, so that one will be an amount of 1276.28. That's 20 times 63.81. Then you multiply by 12% for 5 years, it's 0.5674. And with that, you'll get an amount of 724.16. So therefore, the value of convertible bond, you take the present value of an annuity. Annuity is not changing. What has changed is only the market price of the maturity value. And in this case, you'll get an amount of 1301 shillings. That's the intrinsic value. That's the intrinsic value. And then number 3 of the question. Now, propose 4 advantages that would accrue to Belta Limited by using commercial papers as a source of finance. Now, I have provided these notes on both the personal finance, various sources of finance, internal and external. I've explained everything, their characteristics, their advantages and their disadvantages in the handout which is typed. So kindly you can go through that in your notes. Go through that one in your notes. We try another illustration. May 2019, question 1C. May 2019, question 1C. Question 1C, we are told that an investor hold 1,000 ordinary share in Upendo Limited, a company quoted at the Security Exchange. The company has been paying average dividend of 1.5 per share annually in recent years. The firm dividend are expected to grow at the rate of 10% per annum in the coming 3 years. So in the coming 3 years, there will be a constant rate of 10% per annum. Then the growth rate of 8% per annum over the next 2 years. Thereafter, the growth rate, therefore after, grow at a constant rate of 5% per annum into perpetuity. The minimum required rate of return is 12%, so that's the same as cost of capital required. Using the discounted cash flow valuation method, determine the current value of 1,000 ordinary shares of Upendo Limited. Now, how would we value ordinary shares? Now, how we value the ordinary shares and how we value the fixed returns dates, such as debenture, they are totally different. We see that for the shares, we have, you take the, still using the fundamental theory, at that the present value, the market value of the shares is equivalent to the present value of the all future expected benefits. So in this case, we see that to get the market price per share, that's PO, or the market price per share, you'll take the present value of dividends during the non-constant growth period. Then you add the present value of dividends during the constant growth period. And we say that to get the present value of dividend during the constant growth period, you just take DO 1 plus G R minus G, and then you rediscount since you want the present value. The present value interest factor R period N. So now let's do that question. So period 1, 2, 3, 4, 5. You get the dividend per share. So now let's do that question again. An investor holds 1,000 ordinary shares in Upendo Limited, a company quoted at the Security Exchange. The company has been paying an average dividend of 1.5 per share annually in recent years. So to get the dividend per share, we'll take DO 1 plus the growth rate, of which we are told that they have been paying 1.5. Second paragraph. The firm dividend are expected to grow at the rate of 10% per annum in the coming 3 years. For the first 3 years, the growth rate will be 10%. Then the growth rate of 8% over the next 2 years. Over the next 2 years, 8%. And thereafter grow at a constant rate of 5%. Now from year 5 onwards, it will be growing at the rate of 5%. Now between year 1 to year 5, now that's what you call the period during non-constant growth period. Then after 5 years now to perpetuity, it will be constant at the rate of 5%. Now that's what you call during the constant growth period. So now let's determine the expected dividend per share. The most recent dividend per share was 1.5. For the first 3 years, it will be growing at a rate of 10% per annum. So it's 1 plus G, 0.1. So with that, what do we get? So here you get 1.65. Then you take 1.65 times 1.1. You will get 1.815. 1.815 times 1.1. You'll get an amount of 2. Then you take 2. Year 4 to year 5, then for the 2 years, it will be going at an annual rate of 8%. So you multiply by 1.08 or 1 plus G, of which you'll get is 2.16. Then 2.16, you multiply by 1.08, you get an amount of 233. Now, once you get the dividend per share, remember here we want the present value. So you discount the cash flows or the dividends. Present value interest factor, I told that the cost of capital, the required rate of return is 12% year N. Since the dividends are not the same, so therefore we use the first table. It's not an annuity. So 12% year 1 is 0.8929, 7972, 7118, 6355, 5674. Then we get the present value. You take 1.65, you multiply by the discounting factor, you will get 1.47, 1.45, 1.42, 1.37, 1.32, and the total will be 7.03. Now that's now what you call the present value of dividends during non-constant growth period. Then we add the present value of the dividend during the constant growth period. So the present value of dividends during constant growth period, we say that you will take DO 1 plus G, then R minus D. Then you rediscount. Present value interest factor, it's not an annuity. The cost of capital is 12%. Then you always discount using the last period. You see, from year 5 onward, that's when it grows from 5. 1, 2, 3, 4, 5. So use the last one of the 5th year. So how much is our DO? Now from year 5, you see the dividend per share in year 5 was 2.3. So it's 2.33. Then from there you expect it to grow at a constant rate of 5%. You add 0.05. You divide by R. R is the cost of capital, which is 12%. 0.12, growth rate is 0.05. Then you discount to get the present value. 12% year 5, so you use the one for the 5th year. 12% year 5, which is 0.5674. In that case, you'll get an amount of 19.83. So therefore, how do we get the intrinsic value of the share? Intrinsic value, we say that you take the present value during the non-constant growth period, of which during non-constant period we had was 7.03. Then you add the present value of dividend during the constant growth period, of which now we have it 19.83. So that means the current intrinsic value of the share will be 26.86. That's per share. But in this case, we wanted the value for 1,000 shares. So value of 1,000 shares will be 26.86 per share, and this investor want to invest in 1,000, so it will be an amount of 26.86. Good. Now here there is another 0. Yeah. Good. November 2018, question 2C. The earnings per share and the dividend per share data for Maraba Limited over the last 5 years are provided below. So you are given over the 5 years. So you have here dividend per share, earnings per share. We say that whenever you are given the historical information about the data, first of all, use that information to determine the growth rate. Using the compounding method, dn, do, n root minus 1. DO is 2013, then 2014, D1, D2, D3, like that. So DN is the one for 2017, which is 3.5. DO is the one for 2013, the first dividend, which was 2.5. Period, 1, 2, 3, 4, 5. 5 minus 1, that's 4. Because we have D4, then you minus 1. So first of all, we determine the growth rate. You'll get 15.83%. You can confirm that, whether you're getting 15.83. Confirm whether you get 15.83. Additional information. A prospective investor is considering buying the share of the company, which are currently selling at 55 each at the security exchange. So that's the market value of the share. The investor required rate of return is 12%. That's R, or the cost of capital. Required. Advise the investor on whether to buy the shares of Maraba Limited using the Gordon model. How do we get the value of the share using Gordon method? To get the intrinsic value, PO, or the market price per share, well, that's what you call the intrinsic value. You see that you take DO, 1 plus G, R minus G. Yeah, this is what we call using Gordon model. But in this case, we are not discounting because we are determining as a present now. How much DO? So in this case, DO, so here we have made an error. Now DN, the one for 2017 is 1.8. DO is the one which is 1. Good. So this one does not change, 15.83. That one is okay. So DO, you take the most recent, which is 1.8. DO is the dividend for 2017, and the dividend as per 2017 is 1.8. So you take 1.8, 1 plus the growth rate. The growth rate is 15.83, so it's 0.1583. R, the required rate of return, note number 2. The investor required rate of return is 20%, so it's 0.2 minus the growth rate, 0.1583. And how much do you get as the intrinsic value? So the intrinsic value here you get is 50 shillings. So that means the intrinsic value, the value attached to that security, it's worth 50 shillings. But how much is trading? The current market price. Current market price per share, it's 55. So first of all, let's understand the question. Additional information number 1. Additional information number 1. A prospective investor is considering buying the share of this company, which is currently selling at 55. So assuming you're the investor, you want to buy the shares in this company. Intrinsic value, it's 50, but in the market, it's selling at 55. Now the question was required. Advise the investor on whether to buy the shares. Should you buy the shares? No, in this case, you should not buy the shares because the shares have been overvalued. You see, the value attached to that share, it's only 50. But you see, they are selling them at the market more expensive at 55. So therefore, you should hold on. You should not buy that shares now. You should not buy the shares now. We can still try another illustration. November 2016, question 4A. November 2016, question 4A. You are told that Budacho Limited generated 50 million profit after tax in the previous financial year. So in the last financial year, the profit after tax was 50 million. The firm adopted 40% payout ratio as dividend policy. So I want us to determine DO, the most recent dividend. In last financial year, they generated profit after tax of 50 million. That was the profit after tax. Then the firm adopted 40% payout ratio as dividend. So now you want to determine how much was the total dividend. Of this, they pay 40%. Now 40% of 50 million, that is 20 million. That's the total dividends. The firm adopts 40% payout ratio as dividend. The total number of shares issued, ordinary shares, are 10 million. Now, this is the total dividend paid. Now, we want to determine how much was the dividend per share. And we are told that the company has 10 million shares. So, that means the dividend per share was 2 shillings. And that was for the last financial year. So, that means it's DO, the most recent dividend. The company has potential investment opportunity. If undertaken, dividends are expected to grow at the rate of 10% each year for the first 3 years and then stabilize at the rate of 5% each year thereafter in perpetuity. 1, 2, 3. We are told that. If undertaken, the dividends are expected to grow at a constant rate of 10% each year for the first 3 years. Now, for the first 3 years, the growth rate will be 10%. And then stabilize at the rate of 5% each year to perpetuity. Then from year 3, going forward, it will be growing at the rate of 5%. And then you are told that the investor's minimum required rate of return is 18% required. The current intrinsic value of the share. How do you get the market value of the shares? We say that you take present value of the dividend during the non-constant growth period, then you add present value of the dividend during the constant growth period. So first of all, you get dividend per share. We have said that you take DO 1 plus G. DO here was 2, 1 plus the growth rate. For the first 3 years, it will be growing at the constant rate of 10% per annum, so 0.1. So this one will get 2.2. Then 2.2, 1 plus 0.1, you get 2.42. 2.42, 1 plus 0.1, you get an amount of 2.66. Once you get that, we need to determine the present value. It will discount. Present value interest factor. The required rate of return is 18% year end. So this one is not an annuity. So therefore, you use the first table. Use the first table. 18% year one. We have it 0.8475, 7182, 6086. Now with that, we can be able to determine the present value. So to get the present value, take the dividend per share times the discounting factor, have 1.8645, 738, and the total you have is 5.22. So now that's the present value of the dividend during the non-constant growth period. Then we determine, so this is the present value during non-constant growth period. Then we determine the present value of dividends during the constant growth period. And we say that here we'll take DO 1 plus G, R minus G, then to get the present value of discount. Present value interest factor, 18%. Then we say that you always use the last period from year 3 now. DO in this case, now from year 3, the dividend per share in year 3 is 2.66. Then expected to grow at a constant rate of 5%, so it's 0.05. R, 18%, 0.18. You raise the growth rate 0.05. Then you will discount. 18% 3 years, so use this one for the last period, which is 0.6086. And with that, you'll get an amount of 13.1. So therefore, the intrinsic value, you take the present value during the non-constant growth period, which is 5.22. You add the present value during the constant growth period, which is 13.1, and you get a total of 18.32. 18.32. We can try the last question. May 2012, question 2B. May 2012, question 2B. May 2012, question 2B. Cherryman Limited is contemplating to issue 8% bond redeemable at shillings 100 par value in 3 years' time. So how much is the interest? This one is a variation. You see, this one is a bond. So for the bond, you take the present value of an annuity plus the present value of maturity value. How do we get the interest? It's contemplating to issue 8% redeemable at 100 par value. The par value is 100. So therefore, how much is the interest per annum? It's 8 shillings in 3 years' time. So the maturity period is 3 years. Alternatively, each bond may be converted on that date into 30 ordinary shares of the company. The current market price of shares is 3.3, and this is expected to grow at 5% per annum to perpetuity. So we want to determine how much will be the market price after 3 years. Market price per share we say that you take the current market price per share 1 plus the growth rate raised power n. I told that the current market price per share is 3.3, and then the current market price per share is 3.3, and this is expected to grow at 5% per annum to perpetuity, 0.05. Now we want to determine how much will be the price after 3 years. So in the next 3 years, how much will be the market price per share? So the market price per share will be 3.82. The company cost of the debt is 6% per annum. Now the cost of the debt, we use it as the cost of capital. Required market value of the bond, number 1. So how do we get the market value? A market value of the bond, or the intrinsic value of the bond. We say that you take the present value of an annuity, you add the present value of maturity value. So we determine the present value of an annuity. Annuity in this case, we say is the interest, because we are going to pay the interest in each of the 3 years. So the interest per annum is 8. Then you will discount to get the present value. Present value interest factor of an annuity. The cost of the debt we are told is 6% for the next 3 years. So it's 8. Now 6% for 3 years. 6% for 3 years to be 2.6730. If you discount that, you get an amount of 21.384. So that's the present value of an annuity. Then we get the present value of maturity value. Present value of maturity value. We were told that. Now let's go back to the second sentence. Alternatively, each bond may be converted on that date into 30 ordinary shares of the company. So the maturity value, it will be converted into 30 shares, and after 3 years, the expected market price per share will be 3.82. So how much will be the maturity value? So how much will be the maturity value? So the maturity value, it will be 114.6. Then you will discount present value interest factor. This one is not an annuity. 6% for 3 years. So it will be 114.6. 6% for 3 years using the first table, an amount of 0.8396, which you get an amount of 96.22. Then you add the 2. Present value of an annuity, and then you add for the maturity value, you get that the market value is 117.6. And 17.6. Number 2, the floor value of the bond. Floor value of the bond. We had done similar question in class. We see that the floor value of the bond is the value of the bond where it will mature at par value. This is the market value of the bond, assuming that the maturity value will be the at par value. So the formula will still be the same. The present value of an annuity, that one does not change, because annuity, it will remain to be 21.384, the present value. Now what will change here in this case is the present value of maturity value. We are saying that the floor value of the bond is the market value of the bond, assuming the maturity period will be at par value, of which how much was the par value? The par value of the bond was 100 shillings, then you will discount, times present value interest factor 6% 3 years. It will be 100. 6% for 3 years using the first table. Yeah, it's 0.8396. So 100 times that, you'll get 83.96. Then you add the 2. If you add the 2, you get an amount of 105.344. That's the floor value of the bond. And lastly, number 3, conversion premium per share. So how do we get the conversion premium? Now, conversion premium is equivalent to market value of the bond. You compare against the current conversion value. current conversion value. The market value of the bond is what we computed in number 1, the market value of the bond. And the market value of the bond in step number 1 we had was 117.6. You raise the current conversion value. If you have to convert those shares now, how much will be the current conversion value? You see, we are told that the shares can, or the dividend, I mean the bond, can be converted into 30 shares. So it's 30 shares. How much is the current market price per share? Not after 3 years. How much is the current market price per share? The current market price per share we had was 3.3. Now that's how to get what we call the current conversion value. You can convert into 30 shares, and the current market value is 3.3. So the difference between the two, that's how we get the conversion premium, which you get is 18.6. 18.6. Yes, as simple as that. Huh? Yeah, this is another common area for valuation of securities. Yeah, so we better practice more on this on valuation of security. So that marks the end of that Brooks revision class for valuation of security.